All right, this one's crazy a little bit. So notice how there's a lot of steps here. We're going to walk through this question together. You're going to become an absolute pro. And in this comprehensive cash flow estimation question, we're going to be touching on several chapters. We're going to be looking at, of course, cash flow estimation. We're going to look at bond valuation, equity valuation. Then we're also going to be looking at WACC, all right, in order to find the cost of capital. And of course, we're always going to touch on some time value of money, because really, this chapter really is a derivative of the time value of money chapter. So let's go ahead and walk through this step by step. In this case, we're going to try to identify, as we're walking through the question, all of the important stuff, all of the hard stuff. And then you'll see how really something that looks really complicated can be very easy for us. Okay, so let's do this together. Amaze Telecom wants to enter Canada's wireless data services market in order to compete with companies like TELUS, Rogers, and Bell. This doesn't matter to you. If you read a question and you see this, you don't care. This is all fluff. It literally means nothing. So if I were you, I would go ahead and scratch that out. You don't even want to draw your eyes to this. However, the CEO does believe that the company, right, could generate 500 annual phone subscriptions this year. Okay. And the CEO, well, she believes that this figure could grow by 4.5% per year. All right. Already there, some bells should be ringing. Okay. Because they're telling you that, hey, you have 500K of phone subscriptions that you expect to make this year, but you expect that number to grow by 4.5% per year. Now, what are we looking at when we're highlighting stuff in red? We're looking at our operating cash flows. And we know that our operating cash flows is sales minus cost times 1 minus the tax rate. But what is sales? Sales is a function of the number of clients you have. So that number that we just highlighted here, 500K phone subscriptions and 4.5% growth per year, well, that's extremely relevant because it's going to be a factor of our sales. So we need to keep that in mind. And they also let you know that, this project is going to finish at year 6. So that's awesome. They're also letting you know that the annual phone subscription generates $350 to the firm. So they're telling you here that one individual customer that they're able to sign or get, well, that's going to give us essentially a cost of $350. Well, actually, no, it's going to generate, this is our revenues, $350 per individual. But they also let you know that one individual is going to cost approximately $315 to acquire. So if you remember what we talked about at the beginning of this webinar, we said that when you have variable costs, it's probably a good idea to maybe mix that together with essentially our how much money we're making per client. Okay, I'm going to continue and kind of just read through the question, and then we're going to highlight stuff and make it easier for us, just because it is comprehensive. I don't want to get us lost throughout the way. They're also letting you know that the initial investment that is required here is $40 million. So we could go ahead and say that this is CF0. All right, so we have an initial investment of 40 mil. Now, I'm not going to go ahead and write anything, but this should ring a bell too, all right? And your fixed overhead cost, well, that's going to be essentially $3.25 million per year. All right, so once again, notice how we have variable costs and notice how we have fixed costs. What's awesome in this question as well is that they're letting you know that this endeavor could be salvaged for $15 million, okay? So at the end of the project, this will be salvaged for $15 million. Moving forward, they're also letting you know that this will be depreciated using a straight line method. But now this is different, okay? I want you to understand that if you do have a salvage value, that means that you expect to sell this project or whatever for a specific amount at the end of the project. So when you're looking at depreciation, well, depreciation is an accounting method to account for the loss in value of an asset, but only for how much value it loses. In this case, we're not telling you, from that $40 million, you're going to lose all of that value. No, we're telling you that you're going to lose essentially 40 million minus $15 million worth of value. So you're going to lose $25 million worth of value for this project. Essentially, that's one way to look at it until the end of the project. So when we're trying to figure out what's our depreciation, we're going to do 25 million divided by 6, because that's the difference between the project, between the initial investment and its salvage value and its residual value. Okay, so 25 divided by 6. I don't think I'll be able to do the same beautiful mental math, but I'll say, I don't know, 4.167. That's my bet. Does that make sense? Let's look at it now. I need a dopamine. Oh, that's correct. Yes, 4.1. Hey, look at that. I'm doing crazy for math right now. Anywho, so just some cues there. Then they're telling you that note that the board of directors requires, or they required a 250K search study from the consulting company KVA in order to analyze whether this project was viable before approving the investment. Now, this for us does not matter. The reason why this does not matter is because this is what we call, or this is what we define as being a sunk cost. A sunk cost is something that you're gonna have to pay no matter what happens with the project. If you accept the project or if you reject the project, you still pay 250K for the research study. Okay, so for that reason, that cost should not have an impact on the cash flows, on the NPV of the project. All right, that's what we mention as being a sunk cost. All right, it doesn't matter. You don't care about that. So now we can go ahead and read the following point, at which they're telling you that the board of directors, well, they also mention that the project will require the following investments in net working capital. $2.5 million today. All right, that's interesting. And what do we know about NWC0? NWC0, or a change in NWC0, it's always negative. All right, so remember that. But in this case, when we're looking at the total change in net working capital, well, unfortunately, there's multiple years, right? We have 450K at year 1, 320K from year 2 to year 5, and then 520K at year 6. So when we're calculating our change in net working capital, because we want to know how much money is being retrieved from the current operations of the business, or how much money has been added, so lost to the current operations of the business, we're going to need to create a little table, or just like tabulate the data to make sense of this for us, to really find the effect to cash. So it's not as simple as the previous questions we did, at which we just added NWC for year 0. No, in this case, we're going to have to look at the change in NWC for every single year. Okay. Now, it's also safe to assume that the total change in net working capital, so the sum of all the change in net working capital, is going to be recaptured at the end of the project. Okay, that's pretty important. Now, that's a simple little piece of math that we're going to do afterwards, but not an issue. So here's where the stuff gets cracked. Okay, this is a portion of bond valuation and equity valuation in order to find WACC. So we're touching on 3 chapters here. All right. So 9 years ago, Amaze Telecom issued 250,000 15-year semi-annual coupon bonds, okay, with a face value of $1,000 to fund their activities. And we're letting you know that the bond is currently trading at par, while it pays a coupon of $47.5 every 6 months. So before we proceed, just a few things. We know that we're going to look at this in order to solve for WACC. So we could go ahead, and I'll make this clear for you. We're going to look at these 2 buckets, these 2 bullet points, in order to solve for WACC. And the reason why we're looking for WACC is because you'll notice at the bottom that they didn't give you a cost of capital. So these 2 bullet points are made for you to solve for the cost of capital of the firm. And we're going to do that using the WACC formula. So the WACC formula is important because we need to find a few things. You need to find the cost of equity, the cost of debt, the market value of debt, and the market value of equity. And with that, you're going to be able to solve for the cost of capital. In this case here, they're giving you essentially, they're giving you an opportunity to solve for the actual market value. So I'll highlight it here really quickly, just with the number of bonds and the face value of a bond. And if they're trading at par, well, you know that you just do 250K times 1,000. But then they're also giving you, well, they're going to allow you to find essentially the yield to market. And how would you find the yield to market here? Well, we'll look at that later, but it really does touch upon this notion of the coupon payment that they discussed here. All right. Same thing applies with the second bullet point, at which you're letting you know that the common stock of Amaze Telecom is essentially trading at $245 per year, and we have a 1.75 million shares outstanding. With that, you're going to be able to find the market value of equity. Okay. But they're also giving you, because they're weirdos, they're letting you know that it has a beta of 1.45, that the standard deviation on the market portfolio is equal to 14.5%, and the returns on the market portfolio is equal to 8.82, while the risk-free rate is 3.95. Well, that should be ringing some bells for y'all, because that means that we need to use CAPM to find our cost of equity. So it really does touch on a lot of things here. Like, we're talking about a lot of stuff. And that's why we're really going to go through this question step by step. Okay. So another thing that they're asking is that they're letting you know is that the marginal tax rate is 28%. So that's our TC. And they're also letting you know that, yo, do we accept or reject this project? So we're going to go ahead and make this easy for us. There's one thing that we want to just highlight from the very beginning, and that is the initial investment. It's the first thing that we know we could do and that we shouldn't have any like qualms of doing. So we have the values here, but these values mean nothing to you because you don't know how to get to them yet. So we're going to get to them together. So we know first step is I would probably just say the PV of, our initial cash outflow. Well, that's obviously, is this the, did I get the right solution? Hold up, give me a sec. I may have gotten the wrong solution. Let me see. This may be the wrong solution box. So give me a second. I'm gonna pause the share because I may have taken the wrong question box, like the wrong solution for myself. So I'm gonna pause the share. I'll be back in 5 seconds. Okay, so we could actually jump right into it. And it turns out that I think I'm gonna leave our initial investment as $70 million. Now I made this question like I make it, so I kind of have the opportunity to choose how I want it to go. And just to make this more interactive, more fun, we're gonna leave it at $70 million. So we're gonna go ahead and write the present value of our initial investment as being 70 mil. Okay, let's go with that. That said though, still, it doesn't change the fact that the first step remains, assuming no errors from your teachers or whatever on the exam, it remains something that's pretty straightforward. You find that it's equal to $70 million and that's it. Now, the next step is going to be for us to solve for our operating cash flows. Our operating cash flows is where the magic happens. It's typically the first thing that students don't tend to love, but we're really going to walk through this right now. We're going to make sense of it together. Now, before we proceed, I guess I'm going to just, no, we'll use the solution box. Actually, we'll even do something else. If you want to solve for your operating cash flows, right? You're gonna find, your OCF for year one, and then you're gonna plug that in. Because there's a growth rate here, we're gonna need to use the growing annuity formula. But the thing is, within a growing annuity formula, and the more questions you do, the more you'll realize that this would be your first step, is that you need K for your growing annuity formula. But the thing is, we don't have our K, because K is gonna be our cost of capital. And since we don't have our cost of capital, we need to solve for WACC. And they gave us a bunch of information below in order for us to do so. So what we're going to do now is we're going to go ahead and solve for WACC together. I'm going to really walk you through the steps and make sense of them. Of course, I already have the solutions. Of course, I don't want to make this like a 10-hour video, but you're going to see like why are we doing some steps, and hopefully it'll make something that would have been more like something static. It's going to make it a little bit more fun and interactive for you. So let's go ahead and do it. So the first part, in order for us to solve for WACC, I always like to go with the easy stuff. And that's going to be to solve for the cost of equity. So I'm going to zoom in a little bit. We're going to walk through it together. I'm going to assume that you remember the material, you have it on paper, that you're not just watching this, because just watching this will do nothing for you. But let's go ahead and remember that for us to solve for the cost of equity, well, we're going to use the simple, CAPM formula, right? We're going to use our good old friend K is equal to the risk-free rate plus beta times ERM minus the risk-free rate. So I guess no, it's whatever. We'll leave it like that. So that's going to be our formula. That's our CAPM formula. That's how we're going to solve for our cost of equity. In this case, we know that our cost of equity is equal to 3.95%, right? It's not a problem. I mean, sorry, our risk-free rate is equal to 3.95%. If we read the question, yes, it is exactly that. We know that our beta is 1.45. That's what was provided within the question. We know that our ERM is 8.82. And with that, we could go ahead. I'm just making sure that all of my data is correct because I don't want to make a mistake for y'all. But if there's a mistake, you'll let me know. Cool. So we have all the good stuff. Awesome. And with that, we're able to solve for the cost of equity. And it's going to be equal to 11.01%. Now, if I do some quick math, I don't know if I want to do some quick math in my head right now, but it should be equal to something like that. It should be that. I believe it's that. So that's our cost of equity. And the reason why we need our cost of equity, and I'll make it extremely clear for y'all, is because we know that the WACC formula is equal to equity value over the total value of the firm times the cost of equity plus debt value times the cost of debt. So I guess I'll do this times the cost of debt times 1 minus the tax rate. Okay, so just now we were able to solve, so I'll put this on yellow, we were able to solve for the cost of equity. The next step now is to solve for the cost of debt. I like to go through steps, step by step, and make this easier for myself. The cost of debt, what I want you to remember, and that's something that you're going to need to apply within your WACC chapter, right? Or assuming you already did WACC, that's why you're doing this with me now, is that in this question, if we zoom out a little bit, I'll highlight it in yellow, they told us that the company, right, Amaze Telecom, well, it pays, right, semi-annual coupon bonds, okay? Such that essentially it's making payments every 6 months, right? There are 2 payments per year, such that we could actually find our cost of debt by just doing a little tour de passe-passe, okay? So how would you find the cost of debt? You would find the cost of debt by simply understanding a few things. And I guess I'll write it on the side here just because I want us to have some space. So if you know that the coupon of the firm is equal to 47.5 every 6 months, you know that per year, the company pays, I can do some quick math, I'm going to go ahead and say 9.5%, $95. And we know that the coupon is a factor of the face value multiplied by the coupon rate. In this case, we understand that our coupon is 95, and we know that our face value is $1,000, such that to solve for a missing variable, our missing variable would be 9.5%. Okay, that's going to be our coupon rate. However, we know that this was issued at par. So if this is issued at par, we know that the coupon rate is equal to the yield to market. So the market expects the same interest payment on other bonds than what the Amaze Telecom is paying, such that we could say that the YTM is equal to 9.5%. Now, the last thing that we need to look at, right? The cost of debt. Okay. So in order to get the cost of debt, what is the cost of debt? The cost of debt is how much interest, right, does a firm need to pay in order to raise some debt? In this case, it seems like, or in these types of questions, you want to assume like that the company could only issue or raise debt by issuing bonds. In this case, for the company to be able to issue the value that we have here, a bond of $1,000, they need to pay an interest, a cost, right, for their debt. For them to receive money, they need to pay 9.5% every 6 months. Not 9.5%, I mean, not every 6 months, you need to pay 4.75% every 6 months. But if we apply the natural idea of effective rates, we would know that essentially our cost of debt isn't necessarily 9.5%. Our cost of debt actually, well, it has to be compounded. It has to be compounded for us to be able to find the cost of debt for the effective rate if we compound twice per year. That's essentially what I'm trying to say. Such that, sure, we found our yield to market per annum because we know the coupon rate, but we need to find our effective annual rate. That's what I'm trying to get to. And I'm sorry, I'm getting a little bit loopy, a little bit tired, but we need to solve for our effective annual rate. Now, how would you go about doing that? You would go about doing that by just doing this. All right, so your effective periodic rate or effective annual rate should be 1 plus the quoted rate divided by 2, in this case, over, am I on drugs? No, to the power of 2. I think it's that minus 1. I'm going to do it in my head just to make sure. 1.0475 power. Yep, I'm not crazy. I'm not crazy. That is the correct amount. I'm just making sure that I'm not just spilling nonsense, such that your effective periodic rate, if you want the correct amount, is going to be equal to 9.7256%. Okay, so I'll take a step back because I know I'm talking a lot, and I know I'm even getting a little tired myself. So I'm doing this in one shot. But what I want y'all to remember is that in order for us to find the cost of debt for these types of questions that are tricky, it may not be as complicated as this at all times, but they told you that not even told you, they gave you the coupon payment for like essentially one interest payment. And we know that this company pays twice per year, such that you're able to find the total value of payments per year. In this case, it was 95 bucks. With that, if you understand how to find the coupon rate, you get a coupon rate of 9.5%. Because we know the bonds are currently trading at par, we know that 9.5% is equal to the yield to maturity, which is essentially like the actual cost of debt for a firm right now. And that's going to be 9.5%. But the thing is, we gotta literally account for the number of compounding periods or the number of payments done by the company. So for us to find the number of compounding periods, for us to be able to find the effective cost of debt, we just need to look at the frequency of payments of the company. In this case, the frequency of payments of the company is equal to 2, such that you would put your M in your effective periodic rate formula as being 2. And you would get your cost of debt being equal to 9.73. Hopefully that gives you some context. So with that, you're able to find your cost of debt. Now we're smiling. This is getting easy. Now what we need to do is we need to find our equity value and our debt value. This is a walk in the park. Our equity value and our debt value is going to be pretty simple. All that you need to do, because we're looking for the market value of debt and the market value of equity, is you just got to take the number of shares or the number of bonds outstanding multiplied by literally the trading price of those shares or the trading price of those bonds. In this case, I hope it's like straightforward. We're just going to do A times B, and the value of our equity is going to be A times B. All right. That's literally all that we're doing. So we're going to take our 1.75 million shares outstanding multiplied by the current stock price of $245. That's going to give us a value of equity of $428.75 million. Okay. Same thing applies for our debt value. What we're going to do is 250,000, which is the number of bonds outstanding, times the face value of 1,000 per bond. And that's going to give us a value of debt of $250 million. Okay. Now, if you know E and you know V, you're able to solve for V, right? So you're simply going to do 428.75 plus 250. If I could do some quick math, that's going to give us $478.75 million. Okay. So now we could solve for WACC. I'm crazy, 678. You see, I'm getting a little bit tired. I'm not going to lie, a little bit tired. But now that we have this, we could just kind of like put everything back into our framework. So we have our cost of equity, we have our cost of debt, and we have our value of equity, and we have our value of debt, and we have our corporate tax rate. We also need to find our firm value, which is V. Once we have that, we're able to solve for our equity value or equity over value, which is going to give us 63.17%. You could do a quick sense check, right? 428 million over 678 million, that looks like 63.17%. Now, debt over value, well, that's going to be the remainder. Or you could simply do 250 mil divided by 679 mil, all right? And that's going to give you your value here as well. And once you have all that good stuff, as you can see, you have everything you need. You have your D over V, you have your E over V, and you have your TC, such that you just have to plug this in within your formula. And you're going to get a WACC of 9.53%. And this right here, ladies and gents, and everything, this will be our K, 9.53%. Okay, just like that. Now we could actually start solving this question because we need our K. K is our starting point. Because if you take a little step back here and you look at our framework that we've been working with literally throughout this whole session here, is that you understand that for us to find the present value of anything that's not occurring today, we need K. because we need to discount those future cash flows or those future economic benefits, however you want to call them, by K. So that's why this should typically be your starting point. Always solve for K if it's not provided within the question. All right. Now that we have that, we could actually go ahead and solve for our operating cash flows. So it took us a few minutes to get there, but now we could get there, you know what I'm saying? So our operating cash flows. Operating cash flows, well, we need to understand a few things. We know our operating cash flows will be a function of, once again, a few things: our sales, our cost, and our tax rate. Here, our sales, well, our revenues, we're going to need to do a little bit of computation for that. We're going to need to calculate our revenues. Okay, so I'm going to go ahead and write it here, I guess. So we know that our sales is going to be equal to essentially the number of clients. Essentially, if we look at for year one, their sales, our revenues for year one will be our number of clients multiplied by our revenues per client. However, what we're going to do here, because we're sharp, is we're going to actually kind of tweak our revenues per client, because we're going to include our variable costs per client. So what we're going to do here then is I'm going to zoom in a little bit. Sorry about that. We're going to do our number of clients multiplied by our revenue per client less our cost of acquisition, or acquisition costs, I guess we'll write. Per client. Okay. That's going to give us our margin per client. Okay, because that's going to give us essentially our real sales, our real margin per. That's what we're going to call as being our revenue. It's going to make it easier for us. Okay, so just to make that super clear, what we're going to do is we're going to do 350 minus 315. That's going to give us, I could do some quick math in my head, I guess $35 per client. And because we have 500,000 clients, we're just going to do 500,000 times 35. And I don't know if I could impress y'all with some math again. I guess it would be like 1.75 or 17.5, something like that. That's going to be like our value in terms of revenue. And then what we're going to assess as being our cost, well, our cost, we're just going to allocate it as being our fixed overhead costs. Okay, that's what we're going to put as our cost, because we found like our adjusted sales. Okay, now with that said, let's actually go into the section and let's actually solve for it together. All right, so we could go here, and you notice that that's exactly what I did. So we're only going to look at year one. So notice how we got 17.5, which is kind of what I mentioned earlier, which is us simply doing 500K clients multiplied by 35. And what I've allocated as our cost, well, that was exactly the fixed cost that we mentioned above, which was 3.5 milli per year. There's no way I just said 3.5 milli. Now, that amount less 3.25 is going to give us our EBIT. The reason why EBIT is important is because our EBIT is what we're going to have before we actually look at our taxes, right? Our taxes in this case, we know our tax rate's what, 28%. Let me zoom out and go see. It is 28%, and I'll make sure that our numbers are correct so that it works. That's 5. Now there should be a small adjustment here. Our small adjustment should be that this should be fixed costs, and fixed costs, they don't change. So this should be $3.25 million all around. So I'm going to just go ahead and change that real quick. And we'll solve these together, so it's going to be fun, don't you worry. All right. Okay, awesome. Let me just think about something real quick. A look at something right quick just to make sure that this makes sense. You know what? Just because I'm lazy, I'm a lazy person right now. What we're going to do is we're going to say that those fixed costs are going to increase as well. Okay, that's what we're going to do for this question. Just because, or else I'm not trying to modify it, but we could modify it. It's going to be easy as well. But we need to look at our fixed costs as being their own like individual cash flows. But we're not going to do that now. So you're going to get 14.25 as being your earnings before income tax. Okay, then you need to account for your income tax expense, right, which is 28%. And then you would get your operating cash flows for year one. All right, that's what we want to be able to highlight. Now, knowing this, okay, having that amount, we could actually go ahead and kind of think about this again. Because we know that these figures are going to grow. If we go back, they're going to grow by 4.5% per year. And because it's going to grow by 4.5% per year, what we're going to do is we're just going to plug this in within our normal annuity form. I mean, our growing normal annuity formula. Okay, so we're going to plug in all of these values that we understand because we know what our payment is, we know what our K is, we know what our G is, we know what our N is. So we could go ahead and plug this in our normal annuity formula, in which we're going to have 1 minus 1 plus K. I'm sorry about that, 1 plus G over 1 plus K, the power of N. And with that, we're going to be able to solve for the present value together. Now, I'm not going to go ahead and do that because we want to be quick, okay? But when you plug that in, and we understand, by the way, that doing this one by one for every single year, that's going to be hectic. That's not going to be something that you want to do. So using your growing annuity formula is the best way to go about it, right? And with that, you're going to find out that the present value of these cash flows will be equal to 50,125,345, something like that. All right? So then we could go ahead and say, you know what? We solved for the first part of the problem. Now it's about going for our net working capital, our change in net working capital. How do we go about that? Don't you worry, it gets easier from now on. However, this will be the first real time where we're walking through this together. So what we want to do is we want to look at every single year. Okay, we want to look at the change in NWC for every single year, and we're going to see how we do that when we have several different years. In this case, they told you that from year 2 to year 5, our net working capital is going to be 320 grand. Okay, so we're going to have 320K for year 2, 320K for year 3, 320K for year 4, and then 320K for year 5, such that at some point your net working capital will be equal to 0 for a few years, like you're changing net working capital. Let's go ahead and do this together. Sorry about that. I have to like get closer to my desk because my back's starting to hurt. Let's go ahead and write this down. So before we even look at our change in net working capital, what you notice is that the best practice, if I was to take this exam again, if I was to take a class again, is you just want to write down what is your NWC for every single year. Make it easier for you, such that you're able to track the change on a year-to-year basis. Okay? It becomes very easy once you have that in front of you. And we could actually even walk through this example together. You know that here, well, for sure, there's a negative, your net working capital is actually going smaller, okay? Such that you know that if your net working capital is decreasing, this is a positive effect to the firm, right? So this is decreasing, so you have a positive effect to the firm. Here it's increasing, so you have a negative effect to the firm. Here it's also decreasing, so you have a positive effect to the firm. Here it's none of the above, nothing's happening, so 0, none of the above, 0, none of the above, 0. So year 3 to year 4 type of thing, year 2 to year 3, year 3 to year 4, put 0 here. And then here we're increasing, so we're going to have a negative effect. So with that, you're able to kind of have a quick visual cue on what's going on. Okay, if we take a step back, you actually notice that everything that I wrote made sense, right? We always know that year 0, because it requires an immediate investment, that has to be a negative value, right? This is at year 0. We know that, well, from year 0 to year 1, well, because it decreased, because our net working capital went from 2.5 mil to 450K, that means that a lot of the money that was initially trapped in the business, well, we got to recoup it, okay? Perhaps that means that a lot of the initial accounts receivables, they essentially were paid in cash. And a really good way to think about this, and we could put ourselves in the shoes of a business owner. Let's say that you're starting a new business at which, like, you're selling, computers, or yeah, let's say you're selling computers and phones, but nobody knows your product yet, okay? So a lot of your initial products, we're going to sell them on credit to let people actually try the product to see how they like it. Then once they like it, they could pay you in full. It's like, try it out, and then if you don't like it, money back guaranteed type of thing. Well, that's maybe what happened for this business, for Amaze Telecom. And then after or during that year, right, they were able to recoup those accounts receivables because their product was so good. So putting yourself in the perspective of a business owner helps to kind of make sense of what's going on, or you can kind of like BS your way into like working through these questions with your own frameworks. Now, from year 1 to year 2, well, it decreased further. So we were able to recoup more money that was lost in the business. So that's why here we have a negative amount, here we have a positive amount, and here we have a positive amount again. And as I mentioned before, we have $0, $0, $0, and then our net working capital increased from year 5 to year 6, such that we have a negative effect to cash. So now you get to see what we're doing. It's very easy. The first step is you're going to plot every single one of these either on your timeline or in a table. Then you're just going to find the change in net working capital. What happened from year 0, our initial investment, right? Our initial investment in NWC to year 1. Oh, it didn't stay the same? All right. It actually decreased. Amazing. Well, that means that we recouped somebody. So really using that framework helps you a lot. Now that you have the change of your NWC and you understand what's happening to cash for every single one of those years, well, we understand that money that you don't receive today, you got to discount them. So you could actually just discount every single one of these one by one. Of course, year 0 is going to be equal to itself. Then you could do these together. And what I would recommend for you, because there are a few different ways you can do this, is either through one of the following steps. One, you could use the simple discounting method. So you would do every single one of these one by one, and you'd get tired very quickly. You could do that. You could use essentially your NP. I would just use my CF plus NPV formula, and you would get the total present value of this. So really, there's probably like 2 solid ways of going about it. Because notice how this looks like it's initial, like it's individual cash flow, right? This individual set of cash flows at which you have an initial investment because you have something at year 0. So what you could go ahead and do, and I'll put it in a different color just so it's like very clear. We'll go ahead with this. This would be your okay, maybe it's not that clear. We could go ahead and use a different color here. Let's go with this. This would be CF0. This would be CO1, CO2. You could put CO3 as every single one of these years. So you put frequency of 3. And then this would be essentially your CO4. Okay, so that's one way of going about it to make this quick for you, such that you know how to solve for this. You don't need to like make this a long process. And if you want, without even seeing the answer, we could actually do it together. So if you were to open your CF function on your calculator like I am, you could plug in your initial investment. So you have $2.5 million, put it negative. You could put in your CO0 as being 2.0500, so 2.05 mil. You enter that. FO1 is equal to 1. You put your CO2 as 130K. FO2 is equal to 1 as well. You put CO3 as being 0. So leave it at that. But then you're going to put your frequency as being 3. Then you could go to CO4. You're going to put 200K, but it's going to be a negative 200K. And then you're good, right? What we want to do, though, is we need to remember that, sorry about that, my throat is a little bit rocky at this point. We could go ahead and solve for the NPV, because that's what we're going to do. We're going to use the CF plus NPV function. When you are here, just make sure to plug in your WACC, so your K, right? So it's going to be 9.53. And then you can do compute. And I'm curious to see what y'all would get. Yeah, that's exactly the amount that I got. So check this out. What I got is this. I got a negative value. Now, I hope this mirrors, but you're going to get minus 635,837 0.39. Look at what we got here. We got something extremely close. Of course, there's gonna be a small nuance because on my solution sheet, there is no rounding error. I just plugged in a rounded version over K. But the idea here is that on an exam, they would give you a plus or minus 1% margin of error. So you're totally chilling. And these types of questions, you have to show your work, so you wouldn't lose any points. So that's awesome. Just like that, you know how to solve for your present value of net working capital. It's awesome. So we got that out of the way. Pretty easy stuff. Now we're going to go ahead and solve for our net working capital recapture. Your net working capital recapture is very straightforward. Your net working capital recapture, all that you're going to have to do, okay, is you're just going to have to sum all of your change in net working capital. So these values right here. All right. And in this case, you're going to have 520K. And what's really funny, okay, what's really hilarious is that you notice that it's equal to the same value that you have at the end. So that's pretty interesting. So you're going to retrieve all of the money that's in the business. So there's two perspectives to have here. One, you could add all of your changes in net working capital together to solve what you're going to recapture, or you could, it seems like you could take the last amount. You could take the last value of net working capital when you're finishing the project. And because that value, you're receiving it at the end of the project and it's a positive value because you're getting the money that was trapped in the business, right? You have 520K trapped in the business, but upon termination of the project, you're able to retrieve that money. It's back in your pockets, okay? Because that money, you're only retrieving it at the end of the project, it's at year 6. You got to discount it. So there's a few ways of solving for this. You can either use your PV function or your CF function on your calculator, but honestly here, doing 520K over 1.0953 to the power of 6 would also work great. And it would give you 301,000 approximately. That would be the present value of net working capital recaptured. Very easy stuff. Like now it's the easy steps, right? Whoops. And what about the salvage value? In order for us to solve for the salvage value, well, we need to understand, well, how much are we going to be able to sell this project at in the future? And when will this happen? In this case, they told us in the prompt that we're going to be able to sell this project or to sell whatever's left of the project for $15 million at year 6. So this means that you're going to get a positive cash inflow at year 6. However, that $15 million, once again, is not being retrieved today. And because it's not being retrieved today, it's being retrieved in the future, we need to discount that cash flow. And for us to discount that cash flow, it's going to be simple. It's going to be 15 million over 1 plus K, which is our WACC, essentially to the power of 6. So we have 15 million here. What you're going to do is you're going to take 15 mil over 1 plus K to the power of 6. And that's going to give you present value at period 0. This is just like simple reps, one by one. Very straightforward stuff. Okay. At this point, you understand why we need to do that because we're retrieving money. It's part of the value of the project, right? It's like students who buy like a brand new super high-end MacBook for the university classes. And then they're like, you know what, when I'm done university, right? When I'm done taking my engineering or software engineering courses or whatever the case may be, I'll sell it off. So that salvage value is always in our calculations when we make a purchase, either a computer, either a house, either a car, whatever the case may be. The same idea, right, for businesses. They're going to apply that logic as well. So just like that, we have our salvage value. And now the last step, last but not least, it's our tax shield. So our tax shield, how do we go about this? Well, for us to figure out what our tax shield is, once again, we need to look at, well, how much this project cost us? It cost us $70 million. And we know that we're going to be able to sell it only for 15 mil at the end, such that in terms of what has been depreciated on this asset, if I could do some quick math, it's going to be $55 million. And that $55 million, we're going to essentially depreciate it over 6 years. Now, can I do some quick math in my head right now? Probably not. We know that, what, it's 55 mil, so 7, it's going to be like, I don't know, I'm going to say like 8.16 million. No, it's probably not, like 9.16, 8.16, something like that. That's going to be like our depreciation expense. Let's see if my mental math's good. So you see here that once again, our initial investment is 70 mil. We know that the salvage value is 15 mil, such that what's going to be depreciated on this asset is going to be $55 million. And you're going to take $55 million and you're going to divide it by 6 to find how much is our depreciation cost every single year. In this case, it's $9.16 million per year. But that's not what we care about. We care about, well, what is the tax shield that I'm going to benefit from on a year-to-year basis here? Well, every single year, your tax shield will be equal to $2.56 million. Well, not really 2.56, but you get the gist of it. Sorry about that. Now, once you have that value, what's amazing is that you can actually, well, you can depreciate them up to today, because we understand that that tax shield is not occurring at year 0. It's occurring at year 1 all the way to year 6. So we need to discount them individually. Now, you could use a few methods. I say this every single time. You could do the sum of the simple discounting formula. So you could do payment at period I over 1 plus k to the power of I. You add all of them up together. You could use the PV function on your calculator, or you could use the compute CF. The CF plus compute and PV function. And I'll show you how easy it is to do the CF function. So what you would do is you go to CF, you do second clear, and you're going to put CF0 as equal to 0. You're going to put CO1 as being equal to the tax shield, which is 2.566667. Yep, that's correct. So you're going to have exactly this. Now, I don't know if this is being mirrored, but you get the point. You're going to press enter, and this is going to occur how many times? 6 times. So you can do enter for that as well. Then you go to NPV. You're going to put your I as being equal to 5.53. Let me just make sure that that is correct still. Yeah, then you do enter, and you're going to do compute for NPV. And you're going to get, in my case, 11,334, but still, there's a rounding error, so it's understandable. But you're still very close to the answer. And on the exam, you'll show your work, and that'll be adequate. That will be okay as an answer. So notice how it took me 2 seconds to write it, and I had the time to verify whether my inputs were correct. You could do the same. So now we have all of our values. We have every single one of these, one by one. It gets mad easy now, because all that you have to do is you got to add them up together. Add all the 6 categories together, and you'll be able to find the net present value of the project. And in this case, the net present value of the project is minus 191,000. So it would be a reject decision. And that's how you solve a seemingly hard question. But it didn't really require a lot of steps on our behalf. Like, it did, but they weren't complicated. That's what I'm trying to say. Now, what was the goal of today? Well, the goal of this session was to shed some light on a topic that students hate in their Intro to Finance class. But when you really take a step back and you look at it, you understand that this chapter is actually quite interesting for a few reasons. Because you could actually kind of take some of these skills and apply them to your personal life. Then, most importantly, I guess, you could actually empower yourself to be able to study for this chapter in a more human way, in a non-static way, and to actually understand what the heck is going on, such that you don't feel stressed when you're studying, such that you feel capable and empowered when you're studying, and that you're able to score extremely well on your exam for these questions at the very least. That's what we tried to do today. Now, it was a long webinar or web series or whatever the heck we want to call it. But within this web series, not only do you know the steps to take and the methodology that I would recommend, but you also understand what's the actual business case for these things, right? What is the initial cash outflow? Why do we care about the tax shield? And where does it come from? What the heck is the NWC, right? So putting that in perspective was the goal of today. And I really, really do hope that after this webinar, you feel like you know what to do. You feel like you have the tools to do the right thing. And you feel like you're empowered. That's really what ISMA helps is all about. Now, what's awesome here is that there are a few questions that actually quite a few questions that we didn't do together. And these questions, you have all of your solutions there. Now, I will make an amendment to these questions just to make sure that the inputs and the solutions are the same, but I would definitely take this as an opportunity to practice. Okay, why not? Get the exposure to these questions and you have the solutions to them. And if you want to have more step-by-step solutions, or if you want to have different sets of questions, well, there's actually a bunch of them on my website and on my YouTube channel. Okay, so you can go ahead and follow those questions there. It's going to give you even more of a perspective on these topics. So you notice how we touched on so many different things here. Now that said, listen, I hope this video was helpful. I hope it gave you the much needed context that I believe students in commerce need when facing an intro to finance class and facing this Goliath, but cash flow estimation chapter. Yeah, this was fun. I think you're awesome. I think you have all the tools in the world to do amazing. And if a weirdo like me is able to make sense of this, I'm sure you can, because you're way better than me. All right. So that said, I'll see you in the next one. There's so many tools out there, and I hope that this is like one step towards you feeling more comfortable in that like studying process. So yeah, I'll see you in another one. Continue being awesome. Remember that you're a rock star and that this should not be something that makes you feel like school is difficult, that learning is complex. Sure, it could be complex, but when you have the right things and the right resources available, you can do this like fairly well. All right, so that's the vibe. Okay. Anyways, enough with all that. Continue working hard, and I'll see you in another one.